everyone. Today we are going to discuss how to read an annual report. As you can see on my screen, I have this website open which is sec.gov/edgar. So this is the official website of Securities and Exchange Commission, the equivalent body of SEBI in India. So SEC governs all the listed companies, their reporting, etc. Right? So the idea is that we will use the official website. We will pull up the financial statements and annual report of a listed company, and we will go through the format of the report, and the focus would be on financial statement, how exactly those financial statements look for a listed company. If you have watched my earlier lectures, I have covered financial statements of companies in my earlier lectures, right, for listed companies. The idea of this lecture is that after you have completed those financial statements, in today's lecture we will discuss and we will reflect on how real-time financials are presented by listed companies, right? So this is the agenda of the lecture today. Let's get started. Now, as you can see, I will just search for the company that I am looking for. You can search for any company that you want to look into the financial statements, and it has to be a listed company in the US. So what I am going to pull up today is Walmart's annual report. Using this URL, you can look up the annual report of any listed companies in the US as you like. So let's say you like Nvidia, you like Google, you like Apple, you like, let's say, any other company which is your favorite, you can just pull up and look into these financials. For the lecture that we are going to cover today, I am going to look into Walmart. Right, so I will look into Form 10K. That's the annual form which is filed by a listed organization. So I'll pull up the latest one, 2026 one. I have it already downloaded for me. Now, as you can see, this is Form 10K, which we have mentioned over here, right? Form 10K means the annual form, annual return which the company files, right? This is filed with US SEC. Now, the form includes a lot of information. It's not practically feasible for me to discuss everything without intimidating you. So the idea is to keep the lecture light and informative. In case you are very curious about a number of other information which I am not discussing at this point of time, feel free to pull up an annual report and go through it. Now, as part of the 10K, there are a lot of declarations, information which a company has to provide, which is broken down into 4 parts. Part 1, Part 2, Part 3 and Part 4. The focus of today's discussion, like I said, is going to be financial statements. So we will look for financial statements. As you can see, Part 2, item number 8 is financial statements and supplementary data. Now, those of you who are listening to this lecture via a mobile phone, for this particular lecture, I would suggest that you look at this lecture from a laptop because the fonts are small and you might not be able to understand everything which I am projecting. So as you can see on my screen, item 8 is financial statements and supplementary data, and number of financial statements are presented. The first item that we have here is report of independent registered public accounting firm. It is basically a CPA firm which is giving a report on the financials of a company. Now, what kind of report is there? Is it unqualified, qualified, adverse, disclaimer? All this discussion we will reserve for an audit lecture. Right now, we are going to discuss financial statements. So when we look into financial statements, we have statement of income, we have statement of comprehensive income, we have balance sheet, we have statement of shareholders' equity, we have statement of cash flows, and then finally we have notes to consolidated financial statements. As you can see on the screen, each financial statement is referenced by the term consolidated. So consolidated means that this is a financial of a parent organization. So Walmart is a MNC, multinational organization. It has its setups in various different countries. When Walmart presents its financial statement, it consolidates all its subsidiaries in which Walmart has investment above 51% and above. So this is a parent's financial, hence that word consolidated is presented. Now let's look into statement of income. As you can see on the screen, there are 3 years of financial statements which are presented: 2026, 2025 and 2024. Now this is a requirement of SEC, Securities and Exchange Commission, that all financial statements except balance sheet should have the main year's data and 2 years of trailing data, so that it's easily comparable by the investors or whoever is going through the financials. So for income statement, statement of comprehensive income, statement of changes in cash flow, statement of changes in equity, it has 3 years of data, main year's data and 2 years of trailing data. Balance sheet will always have the main year's data and 1 year of trailing data. As you can see on the screen, we start with revenues, then we have net sales, membership and other income, which makes us total revenue, right? Revenues, if you remember in my earlier lecture, we had discussed that revenue is a bigger set of sales. So revenue includes sales and certain membership and other income. That gives us total revenues. From that, we have deducted cost and expenses. So you have cost of sales, or simply put COGS, and operating, selling and general expenses, operating and SG&A expenses. So here Walmart has deducted the operating as well as SG&A expenses, which are non-operating, right? Operating and non-operating in one go, which is allowed as per SEC, which gives them operating income. And then from that, they have deducted all the interest expenses. So interest which is paid for debt, basically for bond, interest for finance lease, interest for, or rather we have an adjustment for interest income, and then we arrive at interest net. So income we have adjusted from the expenditure, which gave us total expenditure for interest, right? So that's the interest aspect of it. Debt, finance and interest income. Then we move on to other gains and losses. So other gains and losses figure is around 2075. So Walmart as a whole would have made certain other gains or overall losses. Here in this case, it is gains. So it's like kind of a positive figure. It is offsetting the interest expenditure. This helps us arrive at income before income taxes, which is $24,469 million, right? They would have mentioned it somewhere, yeah, amounts in millions except per share data. So income before income taxes is $29,469 million. Then we have provision for income taxes, which helps us arrive at consolidated net income, which is $22,270 million, right? And from that, we have kind of broken down NCI component and controlling interest component. So as I said, this is a parent's financials. For a parent's financial, 100% consolidation is done for revenue and all other line items. It's at the net income stage that we bifurcate the components of NCI, which is non-controlling interest. Let's say in a company, Walmart has 70% share. In a company, Walmart has 80% share. In another company, Walmart could have 90% share. So the remaining percentages here, whether it's 30, 20, 10, all put together, we present it as non-controlling interest. Here in this case, it is $377 million. And the remaining net income from this $22,270, when we deduct this 377, we arrive at 21,893. right? So this is the amount of net income which is attributable to Walmart. This 377 Walmart does not own, right? Now again, as a requirement from SEC, whenever a income statement is presented, the company should also be presenting the earnings per share or EPS for that year. So as you can see, EPS calculation is followed. We calculate net income per common share, which is BEPS and DEPS, right? So BEPS is basic earnings per share and DEPS is diluted earnings per share. BEPS for the company is 2.74, DEPS is 2.73, diluted. That means a reduction due to securities which are dilutive or convertible securities, right? So this discussion, what is EPS calculation, what is BEPS, what is DEPS, this discussion will park it for another time, wherein we will deep dive into EPS calculation. You can refer to my EPS calculation lecture, wherein we are doing the financial statement analysis, and under this we will discuss how to calculate EPS. So refer to that lecture in case you want to know more about how to calculate the EPS for a company, right? So here we have basic earnings per share and diluted earnings per share presented for Walmart. Then in order to arrive at the DEPS and BEPS, what is the overall number of shareholders that we have taken? So basically, earnings per share formula is net income divided by total shareholders. This is a little more complicated discussion as we have right now. So again, that's the reason, refer to my EPS calculation video, right? For now, you should know that EPS is nothing but net income divided by number of shares, number of common shares. So we have the net income, which is 21,893, and this is the number of shareholders given to us, which is for basic it is 7983, for diluted it is 8022, right? Which gives us 2.74 and 2.73 as the BEPS and DEPS for the company. On top of that, they have also given us the information of dividends declared per share. So basic earning per share was $2.74. If you see, the dividend which was actually paid is $0.94, not really one full dollar. So the difference between earnings per share and dividend declared is, earnings per share is a notional income for an investor, for a shareholder, that notionally their participation in the earnings for the company is roughly $2.74 for that particular year, and from that $2.74 of earning, they received 94 cents as dividend. So dividend income is actually something which they receive in their hand, whereas 2.74 or EPS is a notional number. Okay? So this is a discussion of the income statement for a company, for a listed organization. Now, as you can see, they are just final figures which we have presented over here, right? So there are no discussion, there are no inner columns, there are no outer columns, etc. The idea is to keep the statements clean, and all the information in terms of calculation, etc., how exactly that figure was arrived, is parked in the notes to the financial statement. So in case you want to know more about, hey, how this net income, net sales figure was calculated, how was the interest on debt was calculated, right? Whenever you want to deep dive, you have to refer to the notes to the financials which are accompanied by these financials. At the end of these financials, you will be able to find notes to the financial statement. So this is income statement discussion. Let's move on to comprehensive income. Right? Again, the idea is that you would have gone through the net income statement discussion, and here you are trying to understand the statements of a listed organization. So as you can see, Walmart has opted for two separate statements. They have chosen to present net income and comprehensive income separately. So again, what we will do is we will start from net income attributable to Walmart. We started with consolidated net income. We again represented NCI interest. We represented income attributable to Walmart. From that, we did the adjustment for OCI items, other comprehensive income items, the list which we have discussed in the earlier lectures. Now, as you can see, all the line items after income from continued operations has to be presented net of tax, right? Only here you will find the taxation calculated separately. After all the items that we come across for income from continued operation calculation, we present everything net of tax. So all these items have already been adjusted for tax, hence you will not find a separate tax calculation. So we started with net income attributable to Walmart. From that, we did the discussion of other comprehensive income or loss net of income taxes. So we had, now as you can see over here, we start with consolidated net income, again representation of NCI and portion which belongs to Walmart has been discussed. Now if you see this line item, they have clubbed all the OCI items and shown one step approach. Again, finally we arrive at comprehensive income for Walmart. We have shown separate component for NCI and then separate component for Walmart's controlling interest, right? Now this is how we go about for statement of comprehensive income, right? So this is all the discussion for the two statements. Now let's move on to consolidated balance sheet, right? As you see, the balance sheet is pretty comprehensive. Again, it is a parent organization. Walmart is a pretty big organization and it will have number of assets, number of liabilities. Let's go through these assets and liabilities one by one. Now, one thing which you should be aware of before we start with this discussion, the idea for presentation for assets is in the order of their liquidity. So the most liquid asset comes first and the most illiquid asset will come last. So let's get on with our discussion. We start with current assets because they are more liquid. First one is cash and cash equivalent, right? The most liquid asset. Cash equivalents are investments which are going to mature in less than 90 days from the date it is presented, so which is the balance sheet date. So cash and cash equivalent, receivables, which is your accounts receivable, then you have inventories, then we have prepaids and other expenses, then we have total current expenses, then we have total current assets, and then we move on to non-current assets, which are property and equipment, operating lease, right of use assets. So now what SEC has done over the years is it has tried to plug in the gaps the company would have had in terms of their reporting, wherein they can show liability which they have as expense. So the idea of showing operating lease right of use asset is that we are trying to show even those assets which the company is using for a short period of time in their balance sheet. So we are showing the operating right of use assets and operating liability, operating lease liability in the balance sheet. So this is operating lease obligations due within an year, and in case there is more operating lease obligation due beyond a year, we would have presented that under long-term operating lease obligations, right? The idea is that the company cannot do off-balance sheet financing. In case it has some liability, it should be reflected in the balance sheet under ROU asset and corresponding liability, even if it is operating lease. So operating lease is classified as short-term lease. Either it is less than a year or the amount is too small, right? So, but again, with an endeavor to plug in all the loopholes wherein companies could have manipulated the balance sheet to show a merrier picture than it is, the idea is that we've plugged all the gaps. So that means that we have operating lease obligations presented and the operating right of use asset presented in the balance sheet. Then we have obviously financing right of use asset. In case the company is leveraging a long-term finance, financial lease, it is presented in the form of balance sheet against asset and the liabilities as well. Right? Then we have goodwill, intangible, other long-term asset, which gives us total asset. Right? So from the most liquid, we moved on to the least liquid, and then we have liabilities. Right? One more thing to note over here is, as I had pointed out, for balance sheet, 1 year of main data and 1 trailing year's data is presented. If you look into these two financials, there are 3 years of data. Right? When we move on to liabilities and equity, these are the line items we have. We start with current liability. For liability, we look at the most imminent liability, which is going to mature the most recent one. From that, we kind of back calculate to the liabilities that take more time for maturing. So we have the most current or recent due liability, and with that we backtrack to long term or non-current. Right? So we have short-term borrowings, we have accounts payable, we have accrued liabilities, we have accrued income taxes, so all short-term liabilities. Then we have long-term debt due within a year. So again, one unique treatment which GAAP does is, anything which is going to be due in the next 12 months from balance sheet date is treated as current liability, even if that is a part of a long-term liability. So here the company has long-term debt in the form of long-term operating lease obligation, long-term finance lease obligations, and deferred income taxes and other expenses. So anything which is going to be due in the next 12 months will be presented as a current portion. So that's why these long-term operating and finance lease operations obligations we have under current asset as well, because they become due in the next 12 months. So this becomes our current liability. Then we arrive at total current liability, which is $107.4 thousand. Then we have long-term debt. Obviously we've discussed long-term operating lease obligations, long-term finance lease obligations, and deferred income taxes and other. Right? Then you have any commitment and contingencies fund around 293 million. And finally we move on to equity. So again, GAAP uses an equation of asset equals to liability plus equity. So equity is treated separately. Okay, we start with common stock, the common shares of a company. Then we have capital in excess of par value. Basically it is premium, share premium, right? So capital in excess of par value, also known as APIC, additional paid in capital. Both are the accepted terms. Third item here is retained earnings or reserves and surplus, which you might be used to calling them. Retained earnings are basically where the net income of the company gets parked. Then you have accumulated other comprehensive loss, OCI item, which we have here, gets added on a year-on-year basis to accumulated OCI. Here in this case, we had accumulated loss, accumulated other comprehensive loss. Then total Walmart equity, again the same grind. We consolidate 100% of the subsidiaries assets and liabilities and present the NCI portion separately. Non-redeemable controlling, non-controlling interest, which is $6,270 million. This gives us shareholders equity 105,887. Total is 264. So liabilities and equity total is 264, liability total is 105. This 284 ties in with 284 of assets that we have. 1 year of trailing data. Right? That's how a balance sheet deep dive looks like. Right? Again, most important items or most important financial statements are usually the income statement and balance sheet of a company. One more financial statement which is of use to the organization, investors, shareholders, etc., is the cash flow statement, because we want to understand the cash flow of the company. Is it really generating good cash? Though it is showing us a lot of sales, a lot of revenues, does that really translate into cash as well for the company? So a statement of cash flow becomes a very important point of discussion over here. Okay. Next in line though we have is statement of changes in equity. As you can see, again we are discussing 3 years of data. We start with 26, we move to 25 and 24. Obviously for 24 the opening figures would be for 23. So the idea behind statement of changes in equity is we start looking at the opening balance and we map the opening balance to the closing balance, and we try and understand for that year why and how so many things have changed. Rather, what have changed, why and how you can understand from the notes to the financial, right? So we start looking into the closing balance for January 2026, which was 7969, and we kind of deep dive into what changed during the year. So this is the common stock number. Then we have capital in excess of par value, which is EPIC or share premium. Again, then retained earnings, accumulated loss, total Walmart's equity, non-redeemable non-controlling interest or NCI, and then you have total shareholders equity. Basically, all the items of your equity portion are mapped here, and any change, any numbers change have been mapped, so that you know, hey, what changed for me during the year, so that the opening balance was this and closing balance is this. Was any new share issued during the year? Was any treasury stock purchased, right? Treasury stock, by the way, is share buyback. So here you see purchase of company stock, $85 million. That is purchase of treasury stock. The company purchased its own shares back from the market. Okay. Then we have consolidated statement of cash flow. Again, you see 3 years of data. Right? Only in balance sheet we have 2 years of data. Okay. Now, and cash flow is broken down into 3 major components. The most elaborate and most important one is operating activity, cash flow from operating activity, because operations are core to the business. If you are not generating a net inflow from operating activity, the company is slowly or very soon going to close down. Very soon the company might turn bankrupt because it does not generate cash flow from operations. What would be the future of a company if it cannot generate cash flow from its operations, right? Again, unique thing to look out for is in case the company is generating cash flow from its investing activity, right? Investing activities, when the company invests in itself, that means it buys assets, it invests in securities, it invests in stocks, bonds, etc. That's investing activity. In case a lot of cash inflow is shown from investing activity, that can be a red flag, right? Because the company is selling its asset. Why is it that the company is selling its asset? It could be, one reason could be, hey, the company held stocks, it's booking its profit. If that's the reason, that's fine. But if the company is selling its assets, its PP&E, plant, property and equipment, and then the company is making income or cash generation, right? That is a red flag, because the company is selling off its asset. It does not show that the company is maybe making good cash flow from operation. It could be the reason that the company has run into troubled waters, and that's the reason it's starting to sell its asset, right? So when you're looking at a cash flow statement for a company, you should also analyze how is the cash flow moving, which shows a lot about the company, which the income statement and balance sheet fail to show. So we look into cash flow from investing activities, cash flow from financing activities. Financing activities are activities wherein the company raises money. So let's say the company is issuing bonds, the company is issuing common stock, preferred stock, or the company is taking any kind of financing from the market. All that would be parked under cash flows from financing activities, right? The idea, the normal generic flow of money should be that the company is generating finance via financing activity, and then it is investing in itself, in assets, etc., via investing activities. And finally, it is generating positive cash inflow from operating activity. That shows the operations of a healthy organization, which is not just profitable in accrual basis, but profitable in a cash basis as well. So the idea is not to discuss how to create a cash flow statement in today's lecture, but the idea is to understand how to read the cash flow statement. So we have three major components of segments under cash flow. So first one is cash flow from operating activities. Now GAAP requires an indirect format of mapping of cash flow from operations, right? So direct method is not accepted for SEC reporting. You need to present it via indirect method. So that means we start from net income and we do the add back of non-cash expenditures and change in current assets and current liabilities, etc. So we start with consolidated net income, then we add back all non-cash expenditure, depreciation, amortization, then we adjust for investment gains and losses because we will present it here. Then we have deferred income taxes, other operating activities, and adjustment for current assets and current liabilities. Here net cash provided, that means cash is being generated, which is $41,565 million, which is a good thing to have. Then we have cash flow from investing activities. The company purchased for property and equipment, which is good. Proceeds from disposal of property and equipment. At times the companies also sell off its old asset, which is fine. Proceeds from disposal of certain strategic investment. So the company might have entered into those investment with a certain vision which is completed, and hence the company has sold them. Here again cash generated. Payments for business acquisition, net of cash. So the company acquired certain businesses, which is a good thing. Net cash used in investing activities. A good chunk of cash was used in investing, which is basically investing in itself, plant, property and equipment, etc. Then we look into cash flow from financing activity, which is basically net change in short-term borrowings, proceeds from issuance of long-term debt, the company raised debt, repayments of long-term debt, the company repaid certain portion of debt, dividends paid. Now dividend paid is considered as a financing activity for GAAP. The company gets option on the treatment under IFRS, but it does not get an option under GAAP. It has to treat it as a financing activity. Then you have purchase of company stock. This is treasury stock repurchase. Dividends paid to NCI. Again dividend paid. Purchase of NCI. The company repurchased some of its own stock from NCI. Sale of subsidiary stock, other financing activity, net cash used. So this is very typical cash flow statement, and whatever cash inflow and outflow were there were as expected for a cash flow statement. So the total gives us cash at the end of the year, right? So the idea is that the opening cash and the closing cash should balance when we create a cash flow statement, which did for us. Right? So this is all the discussion for the financial statement. So we started from income statement, we looked into comprehensive income, we looked into balance sheet, then we looked into statement of changes in equity, and finally statement of cash flow. Right? Now let's look into notes to financials. Notes to consolidated financial statements of a company. Right? The idea is again not to dissect the totality of the notes to the financial, because it is very comprehensive. Most of the times they can be around 30 items in the notes to the financial. Again, give and take couple of items here and there, basis the complexity of operations, basis the level of the operations of a company, etc. But more or less it is pretty comprehensive. The idea that we have is to understand how exactly to navigate through these notes. Right. Now, the first note in all the listed companies notes to financial is significant accounting policy. What are the accounting policies the company has used for valuation of its various line items in the financials? Right. What are the principles of consolidation the company has used? What are the estimates, currency translation standards, cash and cash equivalents, etc. So I would highly urge you all to go through some of these line items so that you get more insights into how the company arrive at those items, those numbers in the financial statement, in the FS. Right, receivables, inventories, it will discuss all the accounting policies for these line items. What are the policies that it follows? Then when we move on to the next, again you can see that there are certain calculations also which are presented. Right, and that's why I said that more information about the calculation can be acquired from the notes to the financial. Let's look at note 2. So we arrived at note 3. Yeah. Net income per common share. Right. So again, how exactly do we arrive at the diluted and basic earnings per share? Calculation is presented. Then you have shareholders equity. So basically, if I just keep scrolling, you will keep seeing that a lot of numbers are here, and that supports my assertion that you find the detailed calculation in the notes to the financial statements. Right, again it does not make sense for us to go through all the calculation because you might not want to come back and attend any more of my lectures, but I hope I am able to give you an idea of how to look into the financials, how to read them, and how to come over your fear of creating or working on financial statement. I hope I have been able to achieve that objective. In case you want me to work on similar kind of videos, or you have any questions regarding the discussion that we have made today, feel free to drop them in the comments and I will get back to you. Have a great day.